Do this before you start picking stocks to buy. My name is Jeremy. I am a long-term stock investor and part-time day trader who uses this channel as a way to document my thoughts along my investing journey. I wish somebody told me how simple investing can be when I started. Getting introduced to the stock market can be very overwhelming as there are a million different strategies and ways to make money. But if you are careless and don't do your own due diligence or research, you could end up hurting yourself financially. If you are a new investor or just starting out and you have no idea what to buy, do this. Simply start dollar cost averaging or DCAing into a simple S&P 500 ETF. This means that you are consistently buying in at regular intervals and amounts. What it does is that it allows you to buy more of the asset when the price is going up, but also take advantage when it does pull back to buy the dip. In my opinion, this is the simplest and easiest way to get your feet wet in the market. Now, what is an S&P 500 ETF? This is an investment vehicle that you can invest in just like a stock that will track the S&P 500 index for you. When you buy this, you are investing in the top 500 companies publicly traded in the US. It is not split evenly, but it is weighted, meaning that the larger companies like Nvidia, Tesla, Apple take up a larger portion. Now that's cool and all, Jeremy, but that doesn't tell me exactly what to buy. I know, there are many different options that you can choose from. Some popular examples that you might have heard of are VOO, VOO, IVV, SPY or SPY, or SPLG. All you have to do is just type in any one of those into whatever brokerage account that you are using to invest. They all pretty much do the same thing, so you can't really go wrong with any one of those. It really just comes down to preference. I personally invest in Vanguard's ETF VOO in my own long-term portfolio. Okay, but why is the S&P historically a good investment? When you buy an S&P 500 ETF, you are essentially investing in the US. I have heard people say before that they are just scared of stocks in general. Every investment that you make that is worthwhile does come with at least a certain form of risk. The S&P 500 has historically averaged around 8 to 12% returns per year, and has actually returned a little bit higher than that in recent years as well. The nice thing about investing in the S&P is that it is automatically diversified and does adjust its own allocation as needed. I will say time can be a mitigator for risk, meaning that the longer your time horizon is, the lower your risk will be. The stock market is not a get-rich-quick scheme. It doesn't go up 100% of the time. There are pullbacks, which is completely normal and healthy. If you stick to a plan and are consistent, these can be awesome buying opportunities for long-term investors. Now, I have been asked as well, what if my stocks go to zero? If the S&P 500 does go to zero, meaning that the top 500 companies publicly traded in the US are worth nothing, we probably have bigger issues to worry about. At that point, we're probably in some sort of apocalypse. But that's all I got for now. I just wanted to go over the DCA strategy that I implement in my own personal investing. Let me know what you think. What strategies do you use in your investing? Do you invest in the S&P 500? If you like content like this, please consider subscribing. If you have any questions, please don't hesitate to comment. I will see you in the next video.